One of the biggest tax changes now legislated by the federal government is the overhaul of Australia's capital gains tax system. If you own an investment property, shares, a business or other investments, these changes could affect how much tax you eventually pay when you sell that asset. The important thing is that these changes don't actually start until 1 July 2027, which means there is still time to plan. So, how does capital gains tax currently operate? Let's take an example. If you purchase shares for $1,000 on 1 July 2024 and sold these shares for $3,000 on 30 June 2026, the capital gain on those shares would be the proceeds of $3,000 less the cost of $1,000, equaling a capital gain of $2,000. Now, what happens from here depends on who actually owns the asset, as this will determine how the gain is taxed. Let's start with an individual. Tony, the taxpayer, owns the shares and has held them for more than 12 months. As a result, he is entitled to a 50% discount on his gain. $2,000 times 50% is $1,000, which will be the net capital gain. The gain will be taxed at Tony's marginal tax rate. Let's say Tony's taxable income is $50,000. His $1,000 net capital gain will be taxed at 30%, which is his marginal tax rate. So the tax on the gain is $300. But what happens if the assets aren't actually owned by Tony personally? Let's say his company, Tony Co-Proprietary Limited, actually owns the shares. A company is not entitled to a CGT discount, so it pays tax on the full capital gain at the company tax rate, say 25% of $2,000 gain. That tax will then be $500. Let's have a look at another scenario. Say a super fund. Tony holds his shares in his self-managed super fund. As super funds are entitled to a 33% discount, a capital gain of $2,000 becomes a net taxable gain of $1,333. This amount is taxed at 15%, i.e. $200, if the fund is in accumulation phase. If the fund is in pension phase, there will be no tax payable on the gain. If the shares are held by a trust, it's a different scenario once again. At the moment, trusts are not taxed in and of themselves. The method of taxing a gain that arises in a trust depends on the beneficiary actually receiving the capital gain as a distribution. For example, if Tony's trust made the $2,000 capital gain and distributed 100% of that gain to Tony, then the tax will be calculated on the basis of the individual's rules, i.e. a discounted gain at the marginal rate of the individual. As you can see, who owns the asset can make a significant difference to the tax you pay. The question isn't what's the rate of capital gains tax, the question really is who owns the asset.